Hi there, this is Nathan. Today we'll be talking about the cruise industry, more importantly, Carnival Cruise. Given that I was once a shareholder of the company, I am psychologically attached to the company. Moreover, I sold off my position in Carnival Cruise due to the current headwind in the company. I like the business model of the company. Hence, I would like to see if I could rebuild my position in the company. In today's video, we'll be looking at how the pandemic has impacted the cruise industry. At the end of this video, we'll be looking at whether I will purchase shares in the company. Before we continue, please smash the like button. And if you'd like to see more such videos, please subscribe to this channel. Let's proceed and analyze the cruise industry. Firstly, let's look at how the pandemic has shaped up the cruise industry. Due to the pandemic, the international community are afraid that these cruise ships will allow the virus to spread more violently. As there is little space to ensure social distancing, these ships are being seen as incubation sites. Whenever there is someone on board that has contracted the virus, there's a high chance that the virus will spread on board the ship. Moreover, these ships are not allowed to have max capacity due to social distancing rules. This greatly limits and affects the margins of these cruise operators. Secondly, we'll be looking at the main reason why these cruise stocks are rising slowly. This is due to the presence of these COVID-19 vaccines. Not only are there safety measures put in place to curb the spread of the virus, but these vaccines could also be used as another measure against the virus. Hence, there might be a chance that these cruise ships could start to recover back fully. Thirdly, we'll be looking at the stock movement of some of these cruise companies. We'll be looking at how Carnival Cruise move in comparison to the overall stock market. Within a 6-month time frame, CCL is up by around 26.49%, which comes from the past 2 months. In the same period, NCLH is up by around 64.53%, and RCL is up by around 37.84%. However, Nasdaq is only up by around 31.49%. This may seem that the cruise industry is outperforming the Nasdaq, but this is due to the index doing much better previously. Next, we'll be looking at how these cruise stocks fare in 1 year time. While Nasdaq is up close to around 46.28%, these cruise stocks are down huge, especially CCL. This means that there is a lot of catch up that these stocks need to do. Finally, we're looking at the financial information of a company. The first financial statement we'll be looking at is the income statement. In the first quarter of 2019, the company has around $4.7 billion worth of revenue. This increases to $4.8 billion in the second quarter, before further increasing to $6.5 billion in the third quarter. In the fourth quarter, there was a slight drop in its total revenue. Based on the trend, we could see that the company increases its revenue for the first 3 quarters before dropping in the fourth quarter. Next, we'll be looking at 2020 and see how the pandemic has affected the company. In the first quarter of 2020, the company has around $4.8 billion in total revenue. This decreases to $740 million in the second quarter before further decreasing to $31 million in the third quarter. This means that the pandemic has greatly caused the revenue to drop drastically. Based on the 2019 trend, we should assume that the second and the third quarter should have an increase in its total revenue. However, due to the pandemic, there was a decrease instead. Next, we'll be looking at the gross profit of the company. In the first quarter of 2019, the company has around $1.5 billion worth of gross profit. This increases to $1.7 billion in second quarter, before further increasing to 3 billion in the third quarter before decreasing to 1.7 billion in the fourth quarter. Looking at the trend from both the gross profit and the total revenue, we could see that both actually mirrors, which means that if the total revenue increases, the gross profit will increase, and vice versa. Next, we'll be looking at the gross profit of 2020. In the first quarter of 2020, the company has 1.3 billion worth of gross profit. This decreases all the way to a net loss of 1.8 billion in the second quarter before increasing to a net loss of 1.5 billion. Even though there's a slight recovery in the third quarter, it is still a loss. Next, we'll be looking at the operating profit of the company. In the first quarter of 2019, the company has around $387 million of operating profit. This increases to 516 in the second quarter before increasing all the way to 1.9 billion in the third quarter. However, in the fourth quarter, there was a decrease to $485 million. Next, we'll be looking at 2020 operating profits. In the first quarter of 2020, the company has a net operating loss of $710 million. This increases to 4.2 billion net loss in the second quarter before increasing back slightly to 2.3 billion net loss in the third quarter. Based on this result, we could see that the company has a huge margin issue due to the pandemic. Finally, we'll be looking at the profit after tax of the company. In the first quarter of 2019, the company has 336 million. This increases to 452 million in the second quarter, before further increasing to 1.8 million in the third quarter. However, in the fourth quarter, there was a decrease in its profit after tax to 424 million. Based on this trend, we could see that in 2019, all the four important revenue actually reflects to the total revenue. Next, we'll be looking at 2020. In the first quarter, the company made a loss of 778 million. This increases to a net loss of 4.4 billion. However, in the third quarter, there's a decrease to 2.9 billion in the third quarter. This is great as the company is slowly trying to rebuild its profit after tax. Next, we're looking at the margin of the company. The first margin that we're looking at is the gross profit margin. Gross profit margin means that for every dollar of revenue, how much dollar of gross profit does the company earns. In the first quarter of 2019, the company earns around 33 cents. This increases to 35 cents in the second quarter before increasing to 46 cents in the third quarter. In the fourth quarter, there was a decrease to around 36 cents in gross profit margin. Next, we're looking at the gross profit margin of 2020. In the first quarter, the company made a gross profit margin positive of 26 cents. This decreases to a negative $2.36 in the second quarter before decreasing to a $48.07 loss in the third quarter. This means that for every dollar of revenue, the company actually lost around $49. This is shocking, but it is expected as the company is not even making a single revenue, but have to keep up with its costs. Next, we'll be looking at the operating profit margin of the company. In the first quarter of 2019, the company made an operating profit margin of 8 cents. This increases to 11 cents in the second quarter, before increasing to 29 cents in the third quarter. In the fourth quarter, there's another decrease to a 10-cent operating profit in the fourth quarter of 2019. In 2020, first quarter, the company made a loss of 15 cents. This increases to a net loss of $5.65. In the recent quarter, the company made an operating profit margin negative of $75.29. Similar to how the drop in gross profit margin, this actually makes sense. Finally, we'll be looking at the profit margin of the company. In the first quarter of 2019, the company has a positive profit margin of 7 cents. This increases to 9 cents in the second quarter before increasing to 27 cents in the third quarter. In the fourth quarter, it decreases all the way to its second quarter, which is 9 cents. Based on looking at the margins of the company, we could infer that the company uses a lot of its capital just to operate its business. We term this as a capital intensive business model. So how does this impact in 2020? In the first quarter, the company has a negative profit margin of 16 cents. This increases to a negative $5.91 in the second quarter before increasing to $92.26 in the third quarter of 2020. Next, we'll be looking at the balance sheet of the company. Given the company is facing such a dire situation, let's see how much cash that the company has in order to sustain the company. In the first quarter of 2019, the company has around $349 million worth of cash. This increases to $1.2 billion in the second quarter, before decreasing to $1.1 billion in the third quarter, before further decreasing to $518 million in the fourth quarter of 2019. In the first quarter of 2020, however, there was a sudden increase to $1.35 billion. This continued to increase to around $6.9 billion in the second quarter before increasing to $8.2 billion in the third quarter of 2020. This is still the company issuing more shares to shareholders in order to raise cash during this undied situation. Next, let's look at the number of debt that the company has. Next, we'll be looking at the quick liabilities of the company. Let's see how much debt that the company has. In the first quarter of 2019, the company has around $768 million worth of short-term borrowings. This decreases to $480 million in the second quarter before decreasing to $238 million in the third quarter. In the fourth quarter, there was a stabilization of around $231 million. However, in the first quarter of 2020, there was an increase in short-term borrowings to around $1 billion. This further increased to $3.5 billion in the second quarter before increasing to $3.4 billion in the third quarter of 2020. Next, let's look at the long-term borrowings of the company. In the company has both long-term borrowing and operating lease liabilities. In the first quarter of 2019, the company has around $9.1 billion worth of long-term borrowing and $0 worth of operating lease liabilities. This decreases to around $9 billion in the second quarter before decreasing further to $8.9 billion in the third quarter. However, in the fourth quarter, there was an increase to around $9.7 billion worth of long-term borrowings. In 2020, however, there was an introduction of a new debt in the company. It's called long-term operating lease liabilities. In the first quarter, the company has $9.8 billion worth of long-term borrowings and $1.3 billion worth of operating lease liabilities. It increases its long-term borrowings in the second quarter to around $14.9 billion in the second quarter before increasing to $19 billion in the third quarter of 2020. However, in the second quarter of 2020, the company has around $1.3 billion in its operating lease liabilities, which is rather stable. Finally, let's talk about how much debt does the company plans to pay in both 2019 and 2020. In 2019, the company plans to pay in the first quarter around 1.7 billion. This decreases to 1.6 billion in the second quarter before remain roughly the same throughout until the fourth quarter of 2019. In the first quarter of 2020, the company has a plan to pay around 2.2 billion in its long-term borrowings. This increases to around 2.4 billion in the second quarter, which further increased to 2.6 billion in the third quarter of 2020. Next, let's look at the comparison between its quick asset and its quick liabilities. Based on the chart, we could see that the company has a lot of quick liabilities and little cash. In the first quarter, the company has around $649 billion worth of quick assets and around 11.6 billion worth of quick liabilities. While the company tried to increase its cash in 2019, it doesn't seem like it, as in the fourth quarter, the company actually has less quick assets as compared to the first quarter of 2019. However, the company is able to manage to keep its quick liability rather stable, which is quite good. In 2020, however, there was a different case. In the first quarter of 2020, the company has around 1.4 billion worth of quick assets and 14.4 billion worth of quick liabilities. Both quick asset and quick liability increases in 2020. But due to the sheer size of the quick liabilities, the quick asset managed to increase more than its quick liabilities in terms of percentage rise. But in terms of value, the quick liability has increased more than its quick asset. Finally, let's look at the quick ratio of the company. In the first quarter, the company had 6 cents of quick asset per dollar of quick liabilities. This increases to 11 cents in the second quarter, which remains stable in the third quarter of 2019, before dipping to 5 cents in the fourth quarter of 2019. In 2020, in the first quarter, the company has $9 of quick asset per every $100 of quick liabilities. This increases to $31 in the second quarter, before stabilizing in the third quarter of 2020. In conclusion, I strongly believe that the cruise stock is not on buy right now. No matter how you slice it, these cruise companies are not making any money, unless there's a complete change in the business environment. The cruise industry is unbuoyant in my personal opinion. With that, thank you, have a nice day. Goodbye.